Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is April 16, 2025. So I'll start with the dashboards, and the first one is they keep on being interesting to me. So this is the view of 6 equity indexes with ETFs and 1 bond ETF, TLT. And they are ranked from the best performing to the worst performing in the pink box year to date. And then the yellow box gives us the last week. Last week for equity indexes, they were all positive. Bonds, long-term government bonds, TLT, were terrible. It went down 6% last week. But the others were favorable, anywhere from 1.7 all the way up to 7% increase. So very positive. But still, year to date, they're all negative with the exception of EFA, which is the developed markets. But they are all, as you can see on the right side, those 4 rows of dots, 4 columns of dots, are all negative. Everything is below its 20, 50, 100, or 200-day moving average. When I break it down into the sectors, even though last week was positive, the market has come down so far that even with a positive week last week, it only pulled 2 sectors up above their moving average, and everything else is below. So you've got the opportunity for 44 combinations of 11 sectors and four different moving averages. So they were mostly positive on in the yellow box, but year to date they are still not doing very well. The bottom 3 are the more growth-oriented equity sectors, technology, consumer discretionary, and retail. And those were down 14 to 16%, quite negative. So there were none that were positive the previous week, and only 3 this past week. This ended on Friday, April the 11th. So this gives you a view of the S&P 500 for the last 2.5 years. Toward the end of it, and I draw a black arrow here, toward the end of it, you can see that the decline, it was very sharp over about a 2-month period of time. And then at the very end, it went up last week, trying to establish, an uptrend. That may happen, I don't know. Usually when there is this much damage, the attempt to go back up will last for a little bit, but then eventually it collapses and goes on back down further. That's a typical pattern. So we will see what happens here. This is when I put this on a candlestick chart, you can see the same thing. It just gives a little more color to it. So you can see the up periods are measured by the hollow candlestick, and the down periods measured by the red ones. This is kind of a different chart. I haven't shown this before. I thought I would take the S&P 500 and just compress it over a 2-month period of time, and just look at that and nothing else. So you can see the decline, and then where it hits the bottom, and then it tries to go back up. This is a daily chart, not a weekly chart, so it's not going to correspond to a weekly chart. But on a day-to-day basis, what I've seen is the market goes up, and then it goes down, it goes up, and it goes down. And that's what you see here, is a lot of up and down on a daily basis. And that's usually related to tariffs, or the announcement of a new tariff, or a relief on tariffs, or a counter tariff, and increases and decreases and counter tariff. Yeah, they're pushing the market up and pushing it down, really on kind of a daily basis. the NASDAQ 100 and the S&P 500. The S&P 500 being the broad market, and this is a 2.5-year period of time, a weekly chart. So you can see at the very end of it that not only the market went up, but the NASDAQ 100 went up more than the broad market. But if you go all the way back to last July or so, I drew the black arrow to show you the trend is still in a downward direction, meaning that the S&P 500 is more in favor than the NASDAQ 100. This separates growth and value. So you can see when it goes down, it favors value. When it goes up, it favors growth. There's been plenty of both. So lately, this year, you can see from the black arrow that it really has been wanting to go down a lot more than go up. And again, that's favored value type stocks or value indexes more than growth indexes. This is an interesting one because we take the broad market, the S&P 500, and do a relative strength and compare that to the Russell 2000 small cap index, IWM is the ETF. And so when it goes up, it favors the broad market, S&P, large cap basically. And when it goes down, it's favoring small cap. From about November of this past year to present, you can see the uptrend is very sharp. Large cap is definitely in favor and small cap is definitely out of favor. I mentioned that bonds, TLT is the one I'm using. TLT is the ETF for the long-term government bond. When bonds are trending up, this tends to go up the most. But when they're trending down, this tends to go down the most. You can see over this 5-year period of time how it has gone. Bonds are weak. Why? Interest rates have been going up and bond yields have been going up. Or there is the perception that they're going to go up, the anticipation they're going up, and that will push bond prices down. I don't know if you see it or not, but at the very far right corner, there is a move down, a tick down. That is that 6% decrease in the price of long-term government bonds. Yeah, they were trying to go up, but I think the feeling is that interest rates and bond yields are going to be on an upward trending basis. Those who want yields or who looking for income from interest or bond yields from bonds, or bonds are renewing and they're buying new bonds for yield purposes. If that is the case, this continues, this is probably going to be in your favor. If not, if you're relying like on a traditional 60-40 portfolio, you're relying on the price of those bonds, then it's probably not going to be as much in your favor. I took this, I did this kind of like I did on the earlier chart. I put it into a candlestick to just show you, like on bonds, the long-term government bonds. I compressed it since August of last year to show you the degree of up and down and up. So these moves on a weekly basis, you can see the magnitude of the move. And there are more red ones going down, I think, just visually looking at it, than there are hollow ones that are going up. So that to the very far right, you see the price of bonds coming down. People who believe, and maybe some of you use 60-40 buy and hold portfolios, but people who believe in that, especially advisors, really, really believe in it because that's what they've studied as the way to counter risk. And so this environment is, I know it's frustrating, I've talked to many of them, and it's frustrating that, they're not seeing the gains that they wanted, and they're not getting the protection that they've wanted. And this is one of the reasons why. Okay, the dollar, the buying power of the dollar. The dollar has gone down in the last couple of months. Well, I'd say the last 3 months. 3.5 months. Yeah, I put a black arrow to show you the degree to which is going down. What this means is that people who are investing or buying in the U.S. from foreign countries, from other countries, their currency is going further because our currency is weakened. And those in the U.S. that are trying to spend money or buy things abroad, their dollar is not going as far as it used to go. Gold has been doing exceptionally well. This is our big winner, I guess. And when you look at the last week where it goes up like that, and then you look down below at the moving average. Yeah, that's a long ways above the moving average. I think just visually, I can look at that and it looks like, I think that's the highest it's ever been above its 20-period moving average in the last 2.5 years. But yeah, it's kind of, you'd say, a flight to safety. But silver, same thing, sort of. Silver is not as clean of a chart as gold is. It did have a big uptrend, and actually I think the uptrend is even more than gold. But over time, as you can see, silver is just more volatile. It goes up and down more. And I buy silver instead of gold, but I don't buy it for investment purposes. I buy it more for an insurance policy against a decline, and hopefully not, but maybe the eventual collapse of the dollar. But if that ever happens, I'll be glad I'm holding silver. Or if a person holds gold, you'll be glad you're holding some gold. Okay, Bitcoin has been out of favor. It's been coming down, and again, a negative week here. And you can see that general direction. It was going up, and this is represented by the ETF BITO. You could use GBTC or BITB. Those are also good ETFs. I just happen to use BITO. But anyway, yeah, Bitcoin has been on a decline. Volatility. Volatility has gone up a lot. And this is end of week. So the beginning of the week to the end of the week, it went up as high as 45. It was down in the teens, and now is down around 37. And as I'm recording this, it's even dropped further. But you're in a period of high volatility, which it was a couple of weeks ago. Yeah, it can definitely spike, but it doesn't tend to stay there. Asbury Research, they have stayed negative. With 4 or more their indicators, they consider that an indication to stay risk off. And they have been risk off for a while. Now having one indicator, which is positive. The cross-asset relative performance, looking at the 3 columns to the right, the last week, the last month, the last quarter, large cap more favorable than small cap. Blue chips, meaning the Dow, more stronger than the S&P 500, and developed markets stronger than the U.S., and government bonds stronger than corporate bonds, and short-term bonds stronger than long-term bonds. U.S. versus the world. Because of the struggles that we're having in our markets here, this is market related, we are weaker than other countries. The ones stronger than us for those 3 time periods are Peru, Canada, Switzerland, Italy, Germany, Spain, France, the entire Eurozone, South Korea, Thailand, the Pacific, New Zealand, and Australia. The one where the U.S. is stronger is Taiwan. South Korea, which I like this chart because it's a smoother chart than most. Some of them are quite volatile up and down, but this is fairly smooth. The U.S. did very well for a period of time, 4.5 years, And then during the last several months, from I guess December to present, that's about 4 months, it has been declining, which means South Korea in that period of time is stronger than the U.S., measuring it from the market perspective. Okay, silver and gold. As I said, gold has gone up. It's up to $3,226 an ounce. This is the spot price. So when it went through 3,000 and it just kept going. That was kind of a what's going to happen when it hits 3,000. It's continued to go up. It's $3,226 per ounce, and that's a gain over this past week of 6.2%. Silver, 31.80, and it is up 7.5% over this previous week at a price of 31.80. Yeah. The gold-silver ratio is 101.4 to 1, which makes silver a better buy. It favors silver from a buying standpoint. From a value standpoint, it would favor gold. A monster box of silver bullion, just pure silver, or almost pure silver, not silver eagles, for example. A monster box is 500, and this is what one looks like. The price is $16,975. It was not long ago when it was in the 12,000 range. So it's gone up quite a bit, and this includes a $2.15 per ounce markup over spot. That has gone up. Recently, just in the past few weeks, it's been below $1. So this is showing increased consumer demand, not the spot price, but usually the markup, bringing it up to $33.95 per round or per ounce. Thanks to, this is courtesy of my son Preston. Okay, you can read that. Things are troubling for the market. I don't like to make predictions, but it has rallied recently, and I'm hopeful that'll continue. But if it doesn't, it won't surprise me if it turns around and goes back down. And so this kind of, I guess, depicts the mood that's out there about equities. Okay, thank you for watching. If you have questions or comments, feel free to leave them in the comment section below. And if you've not subscribed, I would appreciate it if you would subscribe. And if you want to, you can hit the bell for notifications. Thank you.